Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, March 17th. Happy St. Patrick's Day. Economic calendar last week. So just looking at each of the data points that came out, we give it a positive or a negative. On balance, it was a pretty good week, one notable exception, but most of the economic news that we got last week, we would deem to be favorable. So kind of stripping away the politics, the concern about tariffs, future of the country, just on an economic basis, numbers look pretty good. So we'll start with the JOLTS job opening. It was pretty much in line, a little bit below, or it was a little bit above expectations. Expected to come in at 7.6 million, came in at 7.7. So that's good. Inflation, that was the big news last week. We had the CPI on Wednesday, both the core and the headline CPI numbers, both numbers lower than expected. So the headline number was expected, well, actually both of them were expected to come in at a positive 0.3% month over month for February. Both came in at positive 0.2%, very favorable. The next day, then we had the purchase price index, which also came in favorable. So the PPI month over month was expected to come in at a positive 0.3%, came in flat month over month. That's fantastic. And the core PPI number, producer price index, actually was negative, a negative 0.1, whereas it was consensus it was going to rise 0.3%. So that is all good. Initial jobless claims also, a little surprised by this with expected DOGE layoffs, cuts. I don't know if they're hitting the numbers yet or not. Kind of looks like not. So the expectation was a new 225,000 claims the week before, came in at 220. So beat expectations. Now, the only unfavorable one, and this is significant, the Michigan Consumer Sentiment Index. So this is certainly a concern that regardless of how the economy is actually performing, if consumers are concerned or, for whatever reason, frightened by changes in the economy, political, whatever, not good for the consumer ultimately. So the Michigan Consumer Sentiment Index, that was expected for March to come in at 63.1, way below expectations. This hit on Friday, came in at a 57.9. And Friday, you may recall, was actually a huge up day in the market. So the market actually responded fairly positively on the day despite this. But in total, we just look at all the economic data from last week. This one stands out as negative. The others were pretty positive. So we always take a look what the Atlanta Federal Reserve thinks we have for GDP growth here in the quarter. And here we are near the end of the first quarter. And we mentioned over the last couple of weeks, the Atlanta Federal Reserve became very sour on the U.S. economy, and we're waiting to see those data points that maybe they're looking at that would suggest we'd have this sort of slowdown. So fourth quarter last year, off the top of my head, we'll just say it's 2.5% GDP growth. It was mid-twos, upper twos, so it was very strong. The Federal Reserve Bank of Atlanta thinks we're still going to lose GDP at a negative growth here in the first quarter of negative 2.4%. The U.S. economy has been referred to before as a super tanker. It starts in one direction. It is very hard to get it to move one way or the other. Slow down, speed up. It just isn't that sensitive. So to go from a very positive, almost 3% GDP growth to a negative 2.4, we're not seeing it in other numbers. Maybe they're right, and they've been very right over the last couple of years, so we'll see. In terms of inflation expectations, those continue to decrease. It's in total not dramatic, but the 10-year break-even, inflation break-even, now is 2.3%. So again, that's the expectation built into the futures market of inflation that we should average over the next 10 years. So 2.3%, that's pretty low. This week, we do have a Federal Reserve meeting that meets on tomorrow, but gives a rate decision on Wednesday. Expectation 99% plus. They're not going to cut. Here's the one that is very interesting to me is that end of the year expectations for cuts actually decreased last week. So despite the fact that the Atlanta Federal Reserve thinks the U.S. economy is decelerating dramatically, last week the expectation for interest rate cuts decreased. So a week before, 75% probability built in that we would have 2 cuts or more by the end of the year. That dropped to 51%. And now the probability of getting 3 or more cuts, that fell significantly. I believe last week, I don't have it on the slide, but last week was in the upper 30s. That dropped to a 24% probability. So all of that built into the markets. What happened? Negative equity markets, slightly negative fixed income market here in the U.S. So last week, S&P 500 down about 2.2%. When you look underneath, growth value, large, small, not a lot of difference. Virtually no difference between the S&P and the equal weighted S&P. So really what you saw last week pretty much was a sell-off that was just kind of across the board, indiscriminate. World markets, ex-US, actually did a little better than the US. Not great week, but better than the S&P 500. So developed markets, ex-US, down about 1.2%. Emerging markets only down about 0.8%. Bond market nearly flat last week, slightly negative. Bloomberg U.S. Aggregate Bond Index down 6 basis points, with the 2-year yield up 3 basis points, the 10-year yield up 2 basis points. So let's look at the economic data that will be released this week. We'll be watching very closely. Today, March 17th, retail sales will hit. We haven't seen it yet, but the retail sales month over month, and this is a bit surprising, for the month of January, it grew 0.2% month over month. The expectation, which seems really high, is it is expected in the month of February to have risen 0.6% month over month. Tuesday, we have both building permits and housing starts. Just kind of noise here. One's going to be down month over month. The other is going to be slightly up, so no real data there, I don't think. Fed rate decision, as I mentioned on Wednesday, we're at 4.25% to 4.5%. Absolutely, that's where it'll come in. And Thursday, initial jobless claims and existing home sales. The initial jobless claims, again, last week was an upside surprise, being lower than expected. 220,000. Expectation is it's going to rise a little bit to 224,000. And existing home sales, again, kind of a noisy number, not probably a market mover in any respect. But for the month of February, is expected to come in at 3.9 million. For the month of January, it's 4.1 million. Very unlikely that'll move markets. Well, that's it for our economic wrap-up. We thank you very much for attending. We'll look forward to seeing you next week. Thank you.